In the stock market, there is one rule everyone takes as gospel. When a company dilutes its shares and prints more stock, the price goes down. It's basic supply and demand, right? Well, AMC just completely broke that rule. AMC just announced they officially finished dumping over 105 million new shares into the market. And instead of crashing, the stock instantly surged nearly 10%. How does that even make sense? Today, we are breaking down the hidden math behind AMC's new $150 million cash cushion and why Wall Street is suddenly rethinking the summer movie season. To understand why the market reacted with a green candle instead of a panic sell, we have to look at the financial mechanics of what AMC just pulled off. Back in February of 2026, AMC launched an at-the-market equity program. Fast forward to today, and they have officially crossed the finish line, locking in $150 million in fresh hard cash. Now, if you look at the surface-level numbers, this looks like a drop in the bucket. AMC is currently sitting on a mountain of roughly $3.9 billion in long-term debt, alongside another $3.4 billion in lease obligations. So $150 million doesn't clear the board. But in corporate finance, cash isn't just about paying off the whole bill. It's about buying time and securing financial flexibility. This influx gives AMC a crucial safety net right as they enter their most important season of the year. So why did investors buy up the dilution? It boils down to three major pillars. First, the box office is finally throwing off its post-pandemic hangover. AMC just recorded its highest attended month of May since all the way back in 2019. Over the last 11 weeks, 6 different blockbusters absolutely crushed it, each bringing in domestic opening weekends north of $75 million. CEO Adam Aron even pointed out that this massive box office momentum completely outweighed the market's fear of dilution. Second, look at the sheer trading volume. On a normal day, about 31.5 million AMC shares change hands. Following this news, volume exploded 85% higher, hitting 58.4 million shares. That tells us institutional and retail buyers weren't just passively watching, they were actively trading the liquidity. And third, it shifts the EBITDA trajectory. This capital injection buys AMC the runway it needs to sustain its positive adjusted EBITDA trend, heading straight into the peak summer movie rush. Let's ground this in the raw data so you can see exactly where the stock sits right now. AMC closed the day at $2.28 per share, pushing its total market cap to around $1.3 billion. If we look at the broader picture, the stock has traded in a massive 52-week range between 93 cents and $3.60. This 10% bump puts it in a very interesting technical spot. Right now, Wall Street's consensus is sitting at a cautious hold. Analyst price targets are incredibly divided. The bears have a low target of $1.10, while the ultra bulls are looking up at $4. But the technical median target? It's hovering right near $2.49. That means today's rally puts AMC within striking distance of what Wall Street considers its current fair value. But here's the real secret you need to watch out for if you're trading or holding this stock. While the short-term survival risk has drastically dropped because of this cash injection, the long-term debt hasn't moved. If the upcoming summer blockbusters underperform even slightly, the market's focus will shift right back from the $150 million they raised to the $3.9 billion. The clock is ticking, and the box office numbers over the next 8 weeks are going to dictate the next major trend. The fundamental narrative for AMC is changing fast, and if you want to see exactly how this debt profile matches up against rival theater chains, click on this next video right here, where we break down the entire entertainment sector's balance sheets.